Okay, hello everyone. This is me, Guillaume. I'm here with Nathan Bergs from the Panoptic Research Team. So this is Beyond the Greeks, which is our weekly research live stream that we do here. Research insights on on-chain options, but also options more generally. The topic of today is spot vol correlations in on-chain options, which is a research bite and presentation prepared by Nathan. So I'm very excited about this. And yeah, first of all, how are you doing today, Nathan?
I'm doing fine. How are you doing?
Yeah, pretty good. It's a beautiful day here. Finally feels like summer. That means I got to mow the lawn today or tomorrow, but everything
Mhm.
is fine. Uh, but yeah, so you're in West Virginia, right? So how's the weather over there?
Actually pretty cold. We've
Okay.
been going the opposite direction. So yeah.
It seems like this spring is kind of give and take a little bit of warmth, but then very cold. And we were cold also yesterday, but that's fine. Yeah, can't wait. Can't wait for the beach. Can't wait for the summer. And then
Mhm.
taking some time off too. But yeah, so maybe can you introduce your presentation a little bit, and then I'll share my screen. Yeah. So what's the topic about today? Is it for the presentation?
Yeah, spot vol correlation or spot implied vol correlation is what I decided to look at because I believe, frankly, it's a fairly under-researched topic in a lot of corners. The way I look at it is, the way I mean, you're a physicist by training, but in the finance academic world, a lot of the time you're taught how to value options, thinking that the underlying spot is static, and it's very much not. So I like to look at how there's a code movement of underlying spot returns in the volatility surface.
Yeah, and one thing I trade options in TradFi, and the key maybe expectations that we see in equities is if the price drops very suddenly, COVID crash could be kind of the dot com or like the financial markets crisis,
Mhm.
huge drawdown. So negative price action leads to extremely high IVs. So they are
Yes.
anti-correlated, and VIX is one of those indices that also goes up when the price goes down, and vice versa. Whereas if there's a sudden increase in price, it's not as sudden, but there's a negative maybe decrease or at least a negative correlation with.
Yeah,
I,
equities is one of those that's pretty boilerplate, but crypto is not as clear cut,
all right,
very
so
regime dependent. So
that's again the very interesting topic. But yeah, we'll see how that manifests itself. But yeah, take it away, Nathan.
yeah, this just the title slide, but this kind of just summarizes what we were talking about heuristically, where you see where it's really four quadrants you have to decide from, which is spot up, vol down, spot down, vol down, spot down, vol up. And like you just mentioned with equities, pretty boilerplate, but in other asset classes, not as clear cut necessarily. An example of that is if you look on the left, uh, pretty much the same decision making matrix, but you see the S&P 500, the coffee futures, and the Canadian dollar.
Canadian.
And for the S&P 500, once again, you see those negative return shocks, volatility spikes. But for the coffee futures, it's the opposite pattern. And the Canadian dollar is actually pretty symmetrical.
Interesting. So the way we understand, we maybe interpret this, that the blue curve shows the
Yeah,
yeah. If there's a
S&P.
so it's flat. If there's a positive day, it's kind of flat, no correlation. But if it's going down, then there is that negative correlation, or at least increase.
Yeah, yeah. On the left side of the x-axis, you see those are negative return shocks. So then you see positive volatility shocks.
Mm. And
Then,
coffee, I guess. I think you'll touch on that, but yeah, coffee is a commodity. You don't want to see your cup of coffee go to
yeah,
$25 a cup. So yes, I can imagine that the scary side is the increase of the upside, I guess. And yeah,
yes, yeah.
Canada, very very polite, even-handed,
Mm,
nothing, no scared on both sides, but nothing asymmetrical, which is interesting too.
yeah, and then if you go to the right side of the slide, it's the same graphic but bifurcated. Like for Bitcoin, for BTC and ETH, you see that the positive shocks have a higher impact on volatility than the negative shocks, whereas it's the opposite
Oops,
for.
sorry. Trying to not hide our face, but yeah. So Bitcoin, Ethereum, yeah, a little bit more like coffee. You said like upside risks then.
Yeah, for BTC and at least for this sample, but for ETH, it's the opposite, where the negative shocks have a higher impact. So
Interesting.
it so yeah, it really is just regime dependent, and you can see these two move in perfect concert. You can see them diverge from each other. I'm talking about BTC and ETH. So that's where crypto becomes more nuanced with their own individual risk premium.
Huh. Interesting. So Bitcoin and ETH or Ethereum they have a different profile, whereas ETH is a little bit more like S&P, and then Bitcoin's a little bit more like coffee, I guess.
Yeah, yeah.
Hmm.
At least for that sample period, but I think that's subject to change very rapidly.
Interesting. Very
And,
cool.
and the next question is, how do you trade this in a Greek-centric or option-centric way? And that's through the Greek, the higher order Greek, Vana, which really I mean, to the technical definition is I mean, really there are two. It's the change in delta with respect to the underlying with respect to changes in the underlying implied volatility, or it's the change in vega with respect to changes in the underlying spot return. So that's where it's really just an expression of the spot vol correlation because you can interpret it either way, and it peaks around the 15 delta mark, as this graphic
Mm.
demonstrates.
And the very sharp, maybe blue line, this is like close to expiry, and the more smooth one are longer dated, maybe, or yeah, or it's the reverse.
Yeah,
Yeah.
uh,
No, I
I
think.
didn't really. Uh, yeah, the October 8th, 2020. I pulled this graphic from Samneet Chappelle, if I'm saying his name correctly, from Ledger Prime on
Mm.
Twitter. So I don't know which one was closest to expiry at the shout out to him, but I'm assuming it was the October 8th, 2020.
Yeah, interesting. Again, the at least what I noticed is that there's a very straight line that is kind of very peaked, as you say, at 15 delta. It goes also the 85 or 90 delta on the way down, but yeah, the yellow one is a bit more smoother. You do have this kind of
Mm,
bulge on the low delta side, which might be kind of this indicative of that that reverse kind of relationship. But yeah.
yeah, so the 15 delta mark, since that empirically seems to be where Vanna peaks, that's where I chose to, that was the delta threshold from which I decided to conduct our back tests,
Mm.
which are through the lens of risk reversals, which is either a long or positive risk reversal, positive 15 delta call, you go long, short 15 delta put, and then the short or negative risk reversal is the opposite.
Mm. Yeah.
So that's what I ran on ETH pen options in the ETH 30 bips pull. And the long Vanna position actually generates when you add it up. Uh, I went through May 2021 to May 2025 and selected or combed over and selected the best performing months for each risk reversal just to see how it corresponded with spot ball correlation. And the best performing month for the ETH long risk reversal was July 2022, and the best performing month for the negative risk reversal was May 2022. And the long risk reversal or positive risk reversal produced around 36% during the month of July 22 and 82, whereas the negative risk reversal produced around 17%
Mm.
in May 2022. So the positive risk reversal that amounts to about 3,900% annualized, and the negative risk reversal that's around 550% annualized, or
So you have to time it right.
560%.
It's kind of dependent on the market condition. Maybe May 2022 was the Luna, or Three
Luna,
Arrows. Luna.
exactly.
So if you're timing it right, you do get a huge uh, upside give because of the kind of directionality of your trade, but also I think you show the premia that you receive as well are quite juicy as well for the
Yeah.
each one. Yeah.
So yeah, it's really about trying to master those technical indicators on when to time it. And in this case, for those short pressurized bursts, or those abbreviated pressurized bursts, the long Vanna position, at least in the case of ETH, reigns supreme.
Mm.
Um, so 36% compared to 70%, more than double.
So the long Vana is the. Can you kind of describe that trade? You said it's the
Yeah,
put and call.
it's the positive risk reversal. So the long 15 delta call and coupled with a short 15 delta put.
I see. I see. Yeah. Yeah. The if the two strikes were the 50 delta, it's a
Mm,
long perp, I guess. But then yeah, the
yeah.
risk reversal means that you are uh, less risk between the strikes. But if it does shoot
Mm,
up or down, then this is the most risk or most exposure.
yeah.
But yeah.
And and sorry to interrupt. I should have clarified that on the last slide. OTM calls are assigned positive Vanna, OTM puts are assigned negative Vanna.
Mm, I see.
So when you start at the 15 delta jumping off point, you're really at the maximum positive Vanna when you're shorting that 15 delta put and longing the 15 delta call. And then the opposite when you do the negative risk reversal. So you're trying to maximize your exposure to spot vol correlation in these environments. Um, but that leads me to the next slide, which is the BTC risk reversals. And these you see the opposite dynamic. Now, generally speaking, these are less lucrative than the ETH risk reversals because the ETH risk reversals, if you take the total return 36 plus 17, you get 53%. Whereas for these, you get around 42%, 25% for the negative risk reversal, 17% for the positive risk reversal. Um, so that dynamic has switched, at least from ETH going to BTC. And the highest performing months were October 2021 for the positive risk reversal and May 2021 for the negative risk reversal.
Hmm. And yeah, the Bitcoin price is, I mean, it's such a big asset and so huge that it is less, I would say, less susceptible to these markets or hedge funds blowing up, and then it might be more of a macro type of way
You'd
that.
hope so.
Yeah,
Yeah.
exactly. Again, micro strategy. When that thing unwinds, maybe we'll see the true impact of micro sailor. But yeah, at least the three arrows capital Luna, I don't think affected Bitcoin as much, which is why we don't see this as the biggest move, which is kind of interesting. But yeah,
Mm.
um, so that
And that's
yeah,
a good, oh, go ahead.
no, that's right. I think that trend is also maybe indicative of the different risks. This risk is on different sides, I guess, as we saw earlier. The risk maybe on Bitcoin is a little bit more on the upside. Or at least this is where the correction happens, and ETH was on the downside, which is kind of shifts
Yeah.
where each trade is the most profitable.
And I just wanted to reemphasize what you said on the prior slide, which is like with a synthetic perp, for example, you're going long an ATM call, short an ATM put. This, when you go at the 50 delta, that gives you some directional vol exposure as well.
Yeah.
between the strikes, so that gives
Yeah.
you that added cushion.
And then so the volatility and Vanna formulas, if you want, on Panoptic are slightly different. I don't think we've even kind of
Yes.
shown them. It's a perpetual option, so it's kind of somewhat related to the funding rate, but then the funding rate can also spike. So,
Mm.
but yeah, I can imagine that the sudden moves decrease liquidity, adds more returns. You have kind of this expected IV that kind of blows up, given a large move. And yeah, this is interesting that we see this here.
Well, and to add tack on to what you were saying, like the E30 bips pull sees more volume than the WBTC 30 bips pull. So that might have something to do with, okay, the long Vanna position is relatively more profitable in the case of ETH as opposed to the short Vanna position with the case of BTC. So that might play a role in why you see this dynamic flipped
Yeah, I think
going for
there's
one.
all of these talks about like the execution price, the markouts, all of this kind of looks at how much flow is going through the ETH USDC pool, for instance, how much of that is pure arbitrage, how much of that is kind of real, maybe like retail flow. But figure that during a big crash, you want to maybe unload your meme coins, all of your DeFi tokens. If you sell all of those back to USDC, there's no Uni USDC pair. There's no whatever Aave USDC. There's no Pepe USDC. At least there's not much liquidity.
Mm,
You are automatically getting routed to that pool. So that's thing. One thing that is unique maybe about the ETH USDC markets is that everyone wanting to exit their position back into this maybe safe harbor asset, which is USDC, will get routed there. Will now maybe get a not the optimal execution price on that part of the swap, but they would still get it out. So they are less sensitive to these execution prices. So I would imagine that ETH USDC is probably one of the most non-toxic pools, I guess, that exists
mhm.
because of that
Yes.
natural exit point for anything that has to go to USDC. And again, if you look at BTC USDC, it's rare that you'll go through the BTC routing if you want, unless you start with BTC or you want to buy it or sell it. But yeah, most of the pairs being ETH centric has this natural endpoint exit point, which is USDC.
Yeah, that distinction in IV derivation is really, in many ways, the secret sauce for Panoptic. So, yeah, you might see this dynamic flipped off chain, like in C5 with BTC versus ETH. You may see the long Vanna materialize better than the ETH Vanna or long Vanna, and then the negative Vanna is what supersedes an ETH. So yeah, yeah, that's why we're trying to conduct these studies.
Yeah, no, very cool.
Um, but trying to go into discernible spot vol patterns with the Uniswap IV that we use on Panoptic. I took the rolling 30-day from May 21 to May 2025 in both polls, the rolling 30-day correlation between the Uniswap IV and the simple returns of ETH and BTC in those pools to try to see, okay, what are the patterns around when those risk reversals spike or um, those profitability metrics spike. And really, what I found was that it's not just about the absolute level like of the spot vol correlation. It's about um, the movement you see around it. So, as an example, like this is the highest. Like if you look around, I guess it would be December 2023. That's the highest peak, right, for the E spot vol correlation, but that's not when you saw the highest risk reversal profitability. So if you look at like July 2022, it's pretty low leading up to that point. It's less than zero point 0.6, negative zero point 0.6, and then it spikes up. So it's
So
really about the rate of change.
a lot of work. I like this chart actually. The
Yeah.
time dependence of that correlation I don't know if you're aware of a similar done on the S&P 500, for instance, but it looks to me like it's the average is kind of low, but there is these kind of regimes that suddenly go from very,
Mm,
very negative to very, very positive. And that could be thought of
yes.
maybe as a trade signal or some other like strategy change. And the both Bitcoin and ETH see this. And yeah, I'm surprised by this. It's actually very so the average could be negative or slightly negative, but then their regimes do change quite a bit. And
Yes.
then depending
So
on
it's
where, yeah.
really how rapidly those regimes flip that
Yeah.
seems to be the harbinger. And what backs that up is, see, the bottom graphic on these combined graphics is the Hurst exponent, which I applied to the simple returns, 30-day rolling simple returns in either pool. And what the Hurst exponent is it's a metric to gauge the persistence or trendiness in a time series, really autocorrelation. So the zero point 0.5 red line signals like a random walk, perfect random walk. And if it's above that, the return series is trending. So you expect to see a higher probability of an up day following an up day and a down day following a down day. And then if it's below zero point 0.5, it's mean reverting. So you expect to see it scales from 0 to 1. So if it's below zero point 0.5, you expect to see like a down day follow an up day or vice versa.
Hmm.
So for the most part, both of these are trending. But what I found interesting was that um, around rapid increases in spot vol correlation, you also saw rapid increases in the Hurst exponent. So the price would be suddenly trending. Whereas for and this is for both ETH and BTC. Whereas for negative spot vol correlation or sudden drops, you would see the Hurst exponent precipitously drop. So it'd go more to a mean reverting level.
I mean, and this is our experience in the trading world of crypto. We see some sideways action, nothing very, very interesting, and suddenly huge spike or huge down candle, and then you see the same regime kind of uh, we recover the same regime after 1 or 2 days of very, very active and kind of volatile markets. And that might be also what we see here. But yeah, no, and the same thing with the Hurst exponent. I never heard of it. Again, if we compare this to TradFi, do we have an idea of what the average one is for S&P, or it's also kind of?
Yes, I'm actually getting to that on the next slide.
Oh,
I'm
perfect.
glad
Yeah.
you brought that up. Yeah, if you look at the top graphic, you see how much more. Now, this is a different sample period, but you see how much more BTC trends in
Ooh.
comparison
Mhm.
to oil or the S&P. The S&P is very mean reverting, um, and oil is slightly less mean reverting, but BTC clearly is by far the trendier asset. But the article
Oh,
I
I see.
pulled
And
this
sorry, yeah, just also
from.
for context, the Hertz exponent of zero point 0.5 is pure randomness. And then
Yeah, yeah.
if it seems to be 0.25 or zero point 0.09, but the S&P SPY are very, very low in that case, then very somewhat consistently mean reverting. Whereas
Yes.
the
Yeah.
Hirsch of 0.55, it's like maybe the outlier, but it is above zero point 0.5. Now trending is kind of its main regime, which is also uh, quite different from oil and also S&P. Oh, very cool.
Yeah, and what the article I pulled this from points out, and astutely so, is the fact that like the Hurst exponent can be inflated from the standpoint or manipulated from the standpoint. You could have 200 consecutive days of like 0.1% returns. So your Hurst exponent is high, but the magnitude of the trend isn't captured. So the way they decided to capture the magnitude in this article is like the below histograms to capture how fat the tails are. So how um, fat those movements are within the trend or how large those movements are. I look at it through the standpoint of going back to the prior slide for a second. trying to capture the rate of change or the acceleration around the spot ball or the Hurst, and trying to see how quick the switch flips, so to speak, and what that threshold is, and if that can forecast any outsized like long vanner or short vanner returns, and how to quickly profit on those. So it's all about tweaking and fine tuning those indicators. And if one portends the other one, like if the quick flip the switch in the Hurst exponent presages the spot ball correlation or vice versa.
Hmm. Very.
And to tease, this is something to look at in future research. But we're also in discussions with another protocol on doing this with their off-chain metrics. So I don't want to name drop them here. Maybe I should.
Who knows? Maybe we'll have a special guest. But yeah, this is again the I like this piece because it does compare the BTC ETH, but also kind of roots it back to what we may be more familiar with, which is kind of the stock market and also commodities. And now I think of this like the Hertz exponent being 0.55, it's almost now, it's not even trending, it's just pure randomness. Like it's now a little
Yeah.
bit more like a random walk, whereas S&P and oil might be kind of guided by more external factors, could be macro, could be kind of hedging needs. So maybe digital assets are the one and true kind of efficient market, which is
No,
assuming
that
extreme
is
luminous. Yeah.
true for this sample. It's just comparatively like its heads and tails trendier than the other two.
Oh yeah, that's
That's
true.
what I wanted to point out.
Yep.
And
Yes.
the tails are a lot fatter.
Yeah, we this reminds me of that like other piece that we published maybe years ago of the block by block hop size for the price on Uniswap, and it is definitely extremely fat tailed. So you have normal distribution, you have maybe exponential distributions. Those are actually narrow tailed. It's what we've discovered. It's a power law, and these are famously
Mm,
fat tailed, even like so fat that the variance and mean can have an infinite number. Of course, we can kind of bound this and say the price cannot be more than the total balance of all the Bitcoin in the world.
yes.
But yes, that's also I think the same trends happen in S&P and maybe commodities, but it's easier to extract from blockchain data. But yeah, the
Yeah.
default is maybe a random walk, but with these extremely fat tail kind of jump size events.
Yeah, the great Benoit Mandelbrot was a big fan of both the Hurst exponent and power walls. So
Really?
those tie
Okay.
in together with fractals. Yeah,
Yeah, exactly.
multifractal market analysis. So, but that's my presentation.
Yeah, very cool. I mean, I
Um,
think back in the world of physics, there is kind of I forget the name, I got at BU, but they made their career trying to uncover and unravel power laws. So you don't see power laws in atomic physics, quantum mechanics. All of this is very, very well behaved. Even like
yes,
astrophysics, everything is very, very well behaved. But when you look at human components, city sizes, the stock market, anything that has a human element, inevitably you
yes.
always have a power law somewhere. uh
Anytime you introduce a herd to the equation,
yep.
that's kind of what happens. Yeah.
As opposed to you have more atom, more something, you have like more predictable maybe outcomes. Whereas if you have a, or at least more constrained, if you have a bunch of interacting actors, then you have these extreme outlier events that are maybe rooted in the human psyche of being.
Yeah, the behavioral component.
Yep. Very, very cool. So this is, yeah, thanks a lot, Nathan. This was very cool, very informative. I like this a lot. So this will be repackaged, I think, in a research bite, or maybe can you tell more about that?
Yes, yeah, upcoming research bite, which will be out very soon.
Amazing. So yeah, we do want to have this be complementing. The research bite will be where you can refer to this. This is kind of where we also talk about the context. But yeah, the two, the bite and the live stream, are meant to kind of highlight some unique aspects of blockchain options, the derivatives world. Again, thanks Nathan for this. This was very, 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 very informative. And yeah. I think that's it. Any last
But
word or last comment?
no, just if you have any questions about the bite, or deeper questions when it comes out on Twitter, feel free to let me know.
Yeah, perfect. All right, so that was it for the Beyond the Greeks. This was spot vol correlations and on-chain options. Very cool, very exciting, and yeah, I guess next week will be Amy. But yeah, very excited about this research. This is kind of the core of what we do. We deal with a rich product. I say derivatives have so much depth and complexity that you can do a lot of this research. If we were to study again lending markets, we would be kind of pressed for to find interesting research by it. But this is actually there's a limitless amount of research topics. So yeah, looking forward for this next week,
Yes,
but also all the other ones that
absolutely.
we're preparing. Perfect. All right, so that's it for today. So thanks a lot, everyone. We'll see you tomorrow for the options hour with Brandon and Rosalie as well. And yeah, otherwise, have a good rest.